Alrighty, hello Chris. How's it going? I figured I'd record this so that you can refer to it later on if you don't understand when we go over it. You can just hear it again. Um, so basically, when we're accounting for uncollectible accounts, we're dealing with customers who we sold the product to, but now they're not able to pay for that product. So we sold it to them on credit, okay, or on account. Basically, that means we sold them the product, and then they said, okay, look, we'll pay you within 30 days or whatever terms that you set for your business. Okay, so what originally happens when that happens, or when the sale occurs rather, is okay. So let's pretend we're ABC company, and we're gonna sell the product to Joe. So once we sell the product to Joe, and we sell it on account, meaning that he's gonna pay us in 30 days, we're gonna put an accounts receivable on our balance sheet, okay? Because now he owes us, so it's an asset. And then we're also going to credit sales revenue because we sold it to him, okay? And then when he does pay, if he does, in cash, you're going to debit cash and credit accounts receivable. So you get rid of the receivable once you receive the cash, okay? Um, so there are two methods to account for uncollectible accounts, and one way is the percentage of net credit sales, which is also called the income statement approach, because you're getting a percentage of net credit sales, which is an item that appears in the income statement. And then two, the other method is percentage of ending accounts receivable, which is the balance sheet approach, and that's because it's called that because we're using a percentage of accounts receivable, which appears or is an item on the balance sheet. Okay. So first, it's important to figure out how each of these accounts works, like what affects each account. So the two main accounts we're going to deal with are accounts receivable and allowance for uncollectible accounts. First, as you can see, accounts receivable has a debit balance, and allowance for uncollectible accounts has a credit balance. Okay, this here, allowance for uncollectible accounts, is a contra account to accounts receivable. So it basically reduces your ending accounts receivable. So when you present it on the balance sheet, as you can see right here, you're going to have your ending accounts receivable, okay, minus your ending allowance for uncollectible accounts, okay, and that'll give you the net realizable value of accounts receivable, which is how you're supposed to present it on the balance sheet, okay. So what affects accounts receivable? Well, when you have a credit sale, when you make a sale to somebody on account, they're going to pay you sometime in the future. So that's how accounts receivable goes up with a credit sale. Now they go down with three different ways. They go down three different ways. I don't know if you've talked about all of them yet in class, but the first one is easy. It's when you collect cash from that customer. So when Joe pays you, you're going to debit cash and credit accounts receivable. Okay, the other way is a credit sales return. Okay, so a sales return for a sale that was made on account. Okay, so if you sold something to Joe on account and then he returns it, you're going to reduce your accounts receivable. And then I don't know if you've learned this yet, but you're going to debit sales returns, which is a contra account to sales. But I don't know if you have to worry about that now. Okay, now the key there is that it's a credit sale. Okay, now if it were a cash sale, then you'd be giving them cash back, right? So you would credit cash and then debit sales returns. Okay. The next one is the write-off of uncollectible accounts. Basically, this means that you know somebody's not going to pay. So Joe has just declared bankruptcy, and so now you know he's not going to pay you. So now you're going to write it off. You're going to reduce that receivable by crediting it, and then you're also going to, the corresponding debit is going to be to your allowance for uncollectible accounts. Okay, so right here. Okay, so then That's what affects accounts receivable. Okay, credit sales, cash collected from customers brings it down. Credit sales returns brings it down, and write-off of uncollectible accounts brings it down. Now the allowance for uncollectible accounts. Basically, only two things affect this: your bad debt expense, which increases it, okay, because it's, remember, it has a credit balance, so you credit it, it increases it. So bad debt expense, and then to decrease it, it's write-off of uncollectible accounts. So, like I said, if you were to know that Joe went bankrupt and he's not going to pay you, you would just write it off. Alright? So that gives you your ending balance. And this ending balance just represents the estimated amount that you believe you will not collect from customers that you made a sale to. Okay, so you made all these sales, and then you're basically just predicting, well, I think this amount will not be collected due to past history, whatnot. So let's go over the two methods. First method is the percentage applied to net credit sales. All right. Now it's key to pay attention to how they account for it, okay? Because they're not going to tell you what to do. They're going to say, ABC company applies this percentage to net credit sales, or they'll say, ABC company estimates that 2% of net credit sales will not be collectible. So that means you're using the net credit sales approach, the income statement approach, okay? So in this case, this one's a little easier. When it's a percentage of net credit sales, then when you multiply it out, that is your uncollectible account expense, okay? Which is also known as bad debt expense, okay? So let's scroll up. So this basically is over here. This is your bad debt expense, okay? So then whatever your beginning balance was, plus the bad debt expense that you calculated using this right here, minus your write-off, is going to equal your ending balance, okay? And remember, the ending balance is always what appears on the balance sheet, okay? Bad debt expense is what appears on the income statement. People always confuse that. A lot of times people put bad debt expense over here on the balance sheet. That's wrong. That appears in the income statement. The ending balance appears on the balance sheet, okay? So let's go through an example. You have net credit sales for the year was $1,000. The company estimates 2% of credit sales will be uncollectible. Okay? So here you know you're using method 1. They give you the beginning balance of uncollectible accounts, okay, the allowance, and what the write-offs were for the year. Okay? So we'll construct a T account. We have a beginning balance, 400. We have write-offs of 50, and then because we're using the percentage of net credit sales, you know the 2% times 1,000, which is 20, is our bad debt expense. So that's going to go here. 400 plus 20 minus 50 equals 370. That's your ending balance and allowance for uncollectible accounts. This is a number that goes all the way up here on the balance sheet. This right here appears in the income statement. Alright? So, next page. Alright, method 2. This one, it's still easy, but I guess it involves a little bit more math. But it's still very simple. Method 2 is when the company applies a percentage to ending accounts receivable. Okay, so they'll say 3% of ending accounts receivable is estimated to not be collectible. This is the balance sheet approach. Okay, this number that you get when you multiply the percentage times ending accounts receivable gives you the ending balance, okay, of your allowance for uncollectible accounts. Okay, this does not give you your uncollectible account expense. This gives you your ending balance. Since you know the ending balance, right, now that you calculated that, and you know your beginning balance, and you should, in the problem they're going to have to give you how many write-offs you had, you should be able to figure out where your uncollectible account expense is. Okay, so we can do it using a T account like here or like this. So once again, 3% of ending accounts receivable is estimated to not be collectible. Ending accounts receivable is 30,000. Write-offs is 100, and beginning allowance is 150. Okay, so you have your beginning allowance of 150. This here is what you're going to be looking for. Okay, because remember, your beginning allowance plus your uncollectible account expense minus your write-off equals your ending balance. Okay, so we're trying to figure out for this red number here. So we don't know that yet. I put the answer there, but we're not supposed to know that yet. Then we know our write-offs are 100, and then we know our ending balance is 900 because 3%, okay, of ending accounts receivable, which is 30,000, is 900. So now we just figure out, we have to back it out. So we rearrange the equation and we figure out that it's 850. 150 plus x minus 100 equals 900. So you know it has to be 850. Or the better way to do it actually is by using a T account. So you set it up. You have beginning 150, right? We know our write-offs are 100, and now we know our ending is 900. So to make this true, to make this 900 true, we need to have a bad debt expense of 850. Okay, so that's basically it. One method, the first one, tells you what bad debt expense is, and then you just figure out the ending balance for allowance for uncollectible accounts. The other method gives you the ending balance of allowance for uncollectible accounts, and then you have to figure out bad debt expense. Remember, always on the balance sheet, you're going to put the ending balance of allowance for uncollectible accounts, okay? And then the income statement is where you put bad debt expense. Alright, I hope that helps, and if you need anything else, let me know. Take care. How do I end this?